Welcome from me, Guy Monson, to our regular 6-Minute Strategy. It's our investment conference this week and next, so please forgive me, those who were there last week. You'll recognise some of my slides. As I was putting the final touches to my presentation, investors seem to me to be confronted by an extraordinary confluence of forces today. Economic, technological, political, and even military. These are driving seismic changes in market leadership. Value and dividend styles have rallied, for example, in one of the most violent equity style shifts that I can remember. For President Trump, the outcome too is quite ironic. His MAGA policies and tariffs have actually led to foreign equity markets gaining since the election, notably China and Europe, while US equities have actually been the losers. So where do we go from here? Uncertainty is rising among both US consumers and corporates, and it's damaging confidence, while redundancies are also climbing in the face of Musk's Doge sledgehammer. A US recession, therefore, is now a real possibility. We've taken a more cautious stance in our asset allocation, cutting our equity exposure back from overweight and parking the proceeds in cash, at least for a while. In the slides ahead, we'll look at this in more detail and see what it means for policy under the Trump White House. So let's look in the left-hand panel at some of these violent market reactions. So you can see that dark blue line global equity index rising strongly into January 2025, and then suddenly the sharp drawdown as the US super caps give ground, bringing it almost into line for the last 12 months with the world equity index equally weighted, or a super cap tech name is treated the same as any other stock in the index. On the right-hand panel, you can see this another way round. What was a growth-driven market, that blue line there dominating returns up until December, suddenly this upsurge in value stocks, and particularly in dividend yield stocks, really changes the whole style leadership of US and global markets. What does this mean for asset class in particular since Trump's election back on November 5th? Well, Bitcoin is still leading the charge, but it's down 35% or so from its peak. The real stars have been Chinese equities, gold, and European equities. By contrast, the S&P 500, which of course is meant to be the beneficiary of Trump's policies, actually losing money, and the S&P 500 small cap, which you could say was really domestic industries, falling by almost 8.5%. So a really ironic outcome for the Trump White House. What's caused this? Well, I think people are realizing that Trump 2.0 is both more decisive and importantly more aggressive than what we saw back in 2017. In tariff terms, 25% tariffs on Canada and Mexico, this new 25% tariffs on all steel and aluminium imports, and we've still got these reciprocal tariffs to come. Canada, China and the EU are already retaliating. Mexico may follow. The second point is the tax cuts. Yes, they will be very stimulative, $4.5 trillion tax cuts, but the number is so large that even with $2.5 trillion of spending cuts and revenues perhaps from the tariffs, we still have an overall budget proposal from the Republicans, which is $2.8 trillion higher in the debt it will put on the US economy 10 years from now. So the risks to the bond markets remain. Thirdly, deregulation. Doge is moving very fast, talk of somewhere around 250,000 employees being let go in government over the next year. We think this could be even higher, particularly at the state level, and we've penciled in something around more than like 500,000 jobs. That's going to drag on growth. Immigration and particularly the deportation rate beginning to rise, which will add to tightness in labour markets. Now, of course, Trump's policies always have a kernel of truth. And yes, on the left-hand side, look at the long-term effect for the US of the rise in Chinese exports after they joined the WTO back in 2001. It's almost been exclusively at the expense of the US deficit. And perhaps radical action is needed to turn this. On the other side, I've shown the successive rule book increases by governments and administrations in the US in their first years as they power that overreach of government and expand many of the rules and regulation administration which Trump believes are harming businesses. He wants something more like the Reagan years. What does this all mean for inflation? Tariffs are, after all, taxes which will add to prices for US consumers. Well, the problem's been a relatively sticky core rate. We had a slightly better than expected number yesterday in the States, which is helpful. But if you look at some of the fundamental foodstuffs like eggs and coffee, these are really environmental factors which are going to push some of these prices up for a long time going forward. All these effects are squeezing the US consumer, the Conference Board numbers ticking down there, and business surveys are beginning to fade. We've actually penciled in the possibility of a US recession later in 2025. Where's the reverse? Where's the growth coming from? Well, ironically, the star of the show this year may actually be Germany. You can see on the left-hand side stubbornly low military spending, that dark blue line, and Germany has underinvested for 30 years in its public net investment across its own economy, even well below the UK. But things are changing. Now, we may see action before the weekend here at the Bundestag to put through some of these changes to the debt brake, which require a big majority in Parliament to do this, actually occurring, and this would free Merz up. And an FT Economist poll last week suggested that Germany can take on euro 2 trillion more in debt over the next decade without excessive risk. And things are changing too in defence. Look at Chancellor Merz's speech last week. In view of the threats to our freedom and peace on the continent, the rule for our defence now has to be whatever it takes. So how have we reacted? We've pulled back our overweight in equities to neutral, while we understand a little bit more about the dynamics of the impact of Doge, of Trump's policies and on tariffs on the US economy, and we are to an extent on recession watch. We put that money into cash. We're neutral bonds, government, underweight credit, and holding on to our big gold positions and infrastructure positions, which have been very defensive against this market drawdown. So I hope that gives you a picture. I hope it gives you a first taste of what White House policy means for markets in the months and years ahead. Thank you.